So I came across this question in one of the past questions. It's very interesting, and I decided to solve it and share it with you. So quickly, let me read the question and give some small explanation. Then we attend to the requirements. So the question is saying that a business with its financial year end being 31st December buys two vans on 1st January 2011. Number one for 80,000 Ghana cedis and number two for 5,000 Ghana cedis. It also buys motor van number three on 1st July 20, 2013 for 9,000 Ghana cedis and another number four on 1st October 2013 for 7,200 Ghana cedis. The first two vans are sold. Number one for 2,290 on 30th September 2014 and number two for scrap for 50 Ghana cedis on 30th June 2015. Depreciation is on the straight line basis, 20% per annum, ignoring scrap value in this particular case when calculating depreciation per annum. Required, prepare the asset account for the years to 31st December 2011, 2012, 2013, 2014, and 2015. So there is a question. So the question is particularly based on four assets that was purchased within some years. So every asset and the year that it was purchased and the date that includes. So for us to solve this question, first of all, one thing that you can do for the solution or for you solving it becoming simple for you is you fishing out the information, the necessary information, like the date and the amount of the assets and the number of assets or the asset name. But in this solution, the question didn't include the accumulated depreciation and the disposal account. I'm going to include the accumulated depreciation and the disposal account, and also maybe the depreciation account and the profit and loss account. So this is what you're going to talk about. So first of all, as I said earlier, for you to make this simple for you, you have to fish out. So I'm going to fish out some important informations that when you have, it becomes easier for you to go forward. So first of all, I want to fish out the number of asset that was bought, the amount of money that was used to purchase, and the date. So I'm going to do it like this. I'll write my dates here and write my CD sign here. So the first asset that was bought on January 1st January 2011. That was when the first asset was bought. So January 1st January 2011. And what was the name of the asset? Number one. And it was purchased with an amount of 8,000. And the second asset that was bought was also bought in the same year. So you can also ignore the maybe bringing the same date. So just write here number 2, and it was they used 5,000 to purchase. So that's the two asset that was purchased in year 2011. So 2012, no asset was purchased, but 2013 there was an asset that was purchased, which is asset number 3. So asset number 3 was purchased in 1st July. So July is on the 7th month, 2013. The asset number is that's number 3, and they used 9,000 to purchase. Then the next year, okay, so the asset number 4 was also purchased in the same year. So the same year, but different months. So this one I'm supposed to include it. Asset number 4. So asset number 4 was also purchased in October, which is the 10th month, 2013. Asset number 4, and they used 7,200. So these are the assets that was purchased. So the dates that those assets was purchased, the name of the assets and the amounts. So I want us to include the disposal to it. So assets number 1 and assets number 2, which was in 2011, was disposed of, was sold out. So assets number 1 was sold out for 2,290 on 30th September. So on 30th September is 09 2014. So number 1, disposal, which was 2,290, and the second asset was also disposed of on 30th June 2015. So 30th June is an asset month, 2015. Number 2, also disposal, which was sold for scrap. So the amount was not huge. That was 50 cedis, Ghana cedis. So these are the vital information that one is supposed to get. If we're able to fish out this information, you are half done with the question. Because for you to be able to know that, okay, this year, this number of assets were bought with the amounts, everything. When you're able to fish out this information, you are good to go. So quickly, I want us to dive into the main requirements that you should prepare the asset account. So we're going to start by drawing my T account. So let me write asset account. You draw your T account very nicely, and you bring your dates, your CD sign, your CR, your CD sign here, your dates, and your DR. These things are very necessary because they fetch marks and it makes the work also neat. So this is the T account for assets account. So the first recording that we are going to do, because assets normally has a debit side. All assets are being recorded at the debit side. If you purchase any assets, you record the amount at the debit side of the asset account, because when you purchase an asset, you are gaining, your business is going to increase. So as your business is going to increase, it's supposed to be at the what? The debit side. So as all assets has what? Debit side. So let's check our question and we realize that on the 1st of January 2011, two assets were bought. So we are going to record those assets. So an asset was bought from a certain company because there is two people involved in this transaction. The one that is selling the asset and the one that is buying. Now asset is buying and the person that they are buying the assets from is also selling. So if you are buying, it means you are gaining and the person that is selling is losing. So the person that is selling the assets, whether it's on credit or with cash, is going to reduce. It's going to reduce. So if the person is going to reduce or the company is going to reduce, we are going to credit the person and debit the asset account. So we are going to debit our asset account with these two assets because they were all bought in the same year. So we are going to debit with this amount. But we write the asset name or we can replace it with cash. Then our date will come. So let's quickly move in. So on the 1st of January 2011, an asset was bought. So I'm going to use number 1, cash, because we use cash. $8,000. And asset number 2 was also bought with cash, which is 5,000. So in the year 2011, these were the two assets that was purchased. No asset was purchased in that year again. So if no asset was purchased in that year again, we have to balance off the account. So if you are balancing off the account, we have to add both. So both will give us 13,000. But for us to balance it off as accountants, you are supposed to make both the credit side and the debit side equal, have the same balance amount. So we have to introduce balance carry down. So we are going to introduce balance carry down here. So 31st December 2011, balance carry down is 13,000. Then we balance it off. So now we are done with the first year that the asset was bought, which is 2011. So since we have introduced balance carry down, we have to carry the amount or the total asset that we had to the next year, which is going to be 2012. So the balance brought down is going to be 1st of January 2012. Balance brought down 13,000. And in 2012, no asset was purchased. So since no asset was purchased, they used this asset throughout from January to December. It was used for the full year. So the same asset was used. So since no asset was being purchased, at the end of the month, we have to balance it off. because no asset was included. So for us to balance this one off, we have to also introduce balance carry down. So 2012 balance carry down, which is the same as 13,000. We balance it off. So now we are also done with 2012. So we carry this one, the amount for the carry down to be brought down. So on the 1st of January 2013, balance brought down is going to be 13,000. But in 2013, an asset was introduced. They introduced an asset in the 2013. So let's go back and check. So you could see that the 2011 an asset was being introduced, but 2012 no asset was introduced. That's why we balance off the accounts there. So the same number of assets or vans were used in 2012. So 2013, two assets was also introduced by different dates, but in the same financial year, 2013. So we are going to record asset number 3 and asset number 4 in 2013, adding up to the balance brought down for the 2012. Then you will see the total number of assets or amount of asset that we have for 2013, or we are taking to 2014. So let's record them. So in 2013, an asset was introduced on 1st of July 2013. The asset number is 3, cash, and the amount was 9,000. The amount was 9,000. And the same year, another asset was introduced on, let me check the dates again, on October 2013. On October 2013. And the amount, the number of the name of the asset is asset number 4, cash. The amount is 7,200. So these were the two assets that was purchased in 2013, adding up to the balance brought down for 2013. In 2013, no asset was disposed of, so we are going to balance off our accounts. So we are going to add the 3 to get our total. So let's put on our calculator and let's punch. So the first one is 13,000 plus 9,000 plus 72,000, 7,200, sorry. So it's going to give us 29,200. So the total is going to be 29,200. So as I said, for us to balance off the accounts, the credit side is supposed to be the same as the debit side. So we have to introduce balance carry down. So 31st 12 December 2013, balance carry down is 29,200. That's it. Then we underline it, balance it off. So now we are done with 2013. So we are carrying the carry down to the next year, which is going to be brought down in 2014. So in 2014, 1st January 2014, balance brought down is 2,920. And in 2014, no asset was purchased. 2014, no asset was purchased, but an asset was disposed. So when we go back, we could see that in 2014, they disposed asset number one, which was 2,290. That was the amount. So since no asset was introduced, but rather an asset was disposed, which is number one, we have to introduce disposal in the asset account. So we are going to introduce disposal. And since we are introducing disposal, this is the meaning. If you are having two, or let me say four cars, now we have recorded four assets. So four cars, you bought four cars, but you bought one in 2020, 2021, 2022, 2023, and 2024. So those are the four cars. And you decided to sell the first car that you bought. You still don't have the four cars. It will left with what? Three what? Cars. So this is how this one also mean. When anytime that you dispose an asset, it means that your asset is going to reduce. And how do we reduce our assets? Because assets has a debit side. So for us to reduce our assets, we have to record it at what? The credit side to reduce what? Our assets. So since the first asset was sold off, we are going to introduce disposal so that it will reduce the number of assets that we have now, because we have four assets and we are going to sell off one, so it is going to leave what? Three. So we just want to know the actual value of the three assets that is left. That's the recording that we are going to do right now. So the disposal happened on, let me check the dates, on 30th October, sorry, 30th September 2014. So let me write it here. 30th September 2014. Disposal. And when you are recording disposal, you don't introduce the amount that you sold. You introduce the cost of the asset that you used to purchase the asset, the cost. So we are introducing the 8,000. That was the amount for the first asset. So this is how you are going to record it. And for it to reduce this, the debit side is higher than or bigger than the credit side. So we want to balance it off, as I said it earlier. For you to balance it off, you have to make sure that no asset was also introduced in 2014, and it was only one asset that was disposed of. So we can balance it off so that 2014 will also go. So for us to balance it off, as I said earlier, you are supposed to introduce the balance carry down, so that they will total up to reach the debit side, because the debit side is greater than the credit. So for us to make sure that both are the same, we have to subtract the 8,000 from the 29,200 to give us the difference, and we record it as balance carry down. So this is a calculator, and we still have our amount on top, which is 29,000. So we are just going to subtract the 8,000 from inside from it. So it's going to give us, so there's amount 21,200. So balance 31st December 2014, balance carry down 21,200, and we will be able to balance it out. So we have balanced it off. Now 2014 is also gone. When we check, the question said we should calculate it to 2015. So we are done with 2014, which we recorded a disposal. And in 2015, an asset was also disposed of. The second asset was also disposed. So we are going to do the same recording as the 2014. So we are going to carry down the amount. So now there is a actual amount for the 3 cars that is left. That's what we are taking it to 2015. So 1st January 2015, balance brought down, which is 21,200. So now these are actual value of the asset that the business is having without the 3 cars. So we have sold off one, so it has left with 3 cars. But in 2015, they sold out another car, which is asset number 2 as scrap, which gave us a lower amount of money, which is 50 cedis. It's not huge because it's a scrap. So we are going to also record it like the way we did the 2014. We are just reducing because when we sell the other asset to, it's going to left with 2 assets. So we want to know the value of the 2 assets. That is going to enter 2016. So we just now also dispose of on 30th June 2015 disposal. And we are going to use the actual amount to record, which is 5,000, not the scrap. So we have recorded the 50,000 here, and you could see that the debit side is bigger than the credit side. So for us to make sure that both are the same in our recording, or a balancing of, we have to introduce balance carry down. So balance carry down, for us to get our balance carry down, we have to subtract the 5,000 from the total amount at the debit side, which is 21,200. So minus 5,000 give us 16,200. 16,200. That will give us 21,200. We have balanced it off. 21,200. So since we have balanced it off, we now carry the balance carry down to balance brought down in 2016. So on first, so this one is going to 2016 financial year. Which is, so now this is the amount of money or the value of the asset that we have now in 2016. So this is how the asset account is being done. It's being done for that question that I read. So this is how it is. Very simple and very understandable and very cheap and easy. So I'm going to continue with the other one, which is the accumulative depreciation. After then we also do the disposal accounts.